They tell you 50-50 is fair. Split everything down the middle. Equal halves, clean math, no arguments. Just symmetry. But run the actual ledger, and you'll realize the 50-50 rule isn't a division. It's a wealth transfer disguised as equality. One side walks away with liquid capital, tax advantages, and career continuity. The other side gets illiquid assets, hidden liabilities, and a decade of deferred opportunity cost. The math doesn't lie. It just hides in plain sight. My name is Manuel. And I spend way too much time running forensic audits on the invisible equations that keep high earners and everyday consumers trapped in financial architectures they never fully read. If you've ever watched a divorce settlement, felt the quiet panic of a seemingly equal split, or wondered why the cleanest math leaves one party financially stranded, hit that subscribe button. Because today, we're not debating morality. We're not arguing about fairness. We're dismantling the 50-50 division myth. And we're going to prove exactly how the math structurally favors one side. When you include every tax drag, every liquidity discount, every career opportunity cost, and every hidden transaction fee the legal system refuses to show you. Let's begin with the story. Let's call them David and Elena. Married for 12 years. 2 kids, 1 household, one shared financial trajectory that looked successful from the outside. David built a logistics consulting firm, worked 60-hour weeks, traveled constantly, closed enterprise contracts, maxed out his CPIRA and 401, bought 2 rental properties. His name was on the business licenses. His signature was on the loan documents. His face was on the company website. Elena was a senior marketing director when they married. Earned $85,000 a year. Career track was strong. Promotions were coming. But after year 3, she stepped back. Their first child arrived, then the second. David's firm scaled. Someone had to manage the household. Someone had to handle school logistics, medical appointments, vendor calls, family travel, and the quiet, emotional labor that kept David's schedule running smoothly. She paused her career. She took contract work when she could. She managed the family budget. She kept the household operational. She didn't take a salary. She didn't put her name on the business. She didn't accumulate retirement accounts. She just partnered. When they divorce, the state applies the 50-50 rule. All marital assets split equally. Sounds balanced. Sounds just. But it's not, because 50-50% of face value is not 50-50% of net economic reality. Let's run the actual forensic breakdown. On paper, the marital estate totals $2.4 million. David receives the business, valued at $900,000. He keeps his retirement accounts, $600,000. Elena receives the primary residence, $800,000 in equity, and a taxable brokerage account, $100,000, 50-50, clean, mediated, signed. But face value is not net value, and this is where the architectural asymmetry activates. First, liquidity. David's assets are illiquid. The business can't be sold quickly without a 20 to 30% haircut. It requires his continued labor to sustain valuation. It carries key man risk, client concentration, and market volatility. His retirement accounts are tax-deferred. He can't touch them before 59.5 without penalty. He's locked into a long-term extraction timeline. Elena's assets are liquid. On paper, the house has equity, but it's not cash. It's a liability that consumes cash flow, property taxes, insurance, maintenance, mortgage refinancing. If she can't qualify a loan, she sells, which triggers transaction costs. The brokerage account is $100,000, accessible, but it's already taxed. No future shelter, no compounding advantage. Liquidity has a premium. Illiquidity has a discount. The 50-50 rule doesn't price that. Second, tax drag. David's $600,000 in retirement accounts isn't $600,000 in purchasing power. It's future ordinary income. At withdrawal, he'll pay federal and state taxes. Effective drag? 22 to 30%? $600,000 becomes roughly $420,000 to $468,000 in real value. Elena's house will eventually trigger capital gains tax if she exceeds the $250,000 exclusion limit upon sale. But she doesn't pay it now. David pays his taxes over decades. Elena pays hers in a lump sum, or never, depending on timing and market conditions. The 50-50 rule splits nominal value. It ignores tax timing. Third, opportunity cost. This is the hidden variable nobody runs. Elena paused her career for 8 years. Her earning trajectory dropped from $85,000 to $50,000 upon re-entry. She lost promotion, she lost skill compounding, she lost Social Security accrual, she lost retirement account growth during her highest earning window. Career capital is real wealth. It compounds over decades. It funds retirement. It provides optionality. The 50-50 split doesn't compensate for deferred career capital. It just splits what's visible. Let's quantify the real gap. David's side. Business plus retirement equal to 1.5 million's nominal. After tax drag, illiquidity discount, and risk premium, real net value, roughly 1.05 millions. Elena's side. House plus brokerage equal to 900K nominal. After refinance costs, maintenance carry, career opportunity cost adjustment, and liquidity premium, real net value, roughly 750K. But wait, the 50-50 rule gave them equal nominal splits. The real gap, $300,000 in economic advantage, and that's before legal fees. Divorce litigation typically runs $30,000 to $50,000 per side. Elena pays higher relative fees because her assets are less liquid. She borrows to cover costs. Interest compounds. The gap widens. This isn't gender politics, this is structural math. The system measures nominal value, it ignores present value, it ignores tax timing, it ignores liquidity premium, it ignores career depreciation, and that's why the 50-50 rule structurally benefits the party receiving liquid, low-risk or tax-advantaged assets, while the other party receives illiquid, high-maintenance or tax-deferred assets, and carries the hidden cost of deferred earning power. Let's name the shadow architecture the Nominal Division Trap. Courts don't calculate net economic impact. They calculate ledger symmetry. Mediators close cases faster when they split down the middle. Lawyers bill by the hour. Complexity increases fees. And the parties, exhausted, accept the clean number. But clean numbers hide dirty math, and the psychological trap snaps shut. We're sold the fairness myth because it's emotionally clean. 50-50 feels moral. It avoids conflict. It lets everyone walk away saying they got half. But fairness isn't symmetry. Fairness is net economic reality after taxes, liquidity, risk, and time. The system doesn't price what you sacrificed. It only prices what you accumulated. And sacrifice is the most expensive line item in marriage. So how do you break the equation? You stop treating divorce as a split. You start treating it as a restructuring. Here's your actionable protocol. Step 1, tax-aware valuation. Don't divide face value. Divide after tax, after cost, after liquidity value. Hire a forensic accountant. Run a net present value analysis on every asset. Retirement accounts get discounted by your future tax rate. Businesses get discounted by illiquidity and risk premium. Real estate gets adjusted for carrying costs and sale friction. Only then do you split. Step 2. Career compensation modeling. If one spouse deferred earnings for the marriage, model the loss trajectory. Calculate the wage gap. Factor in lost promotions, reduced retirement accrual, and skill depreciation. Offset it with structured spousal support, asset reallocation, or business equity grants. Don't ignore deferred career capital. Price it. Compensate it. Step 3. Liquidity equalization. Never give one side illiquid assets and the other liquid ones without adjusting for the liquidity premium. If one spouse keeps the business, they buy out the other with a structured payment schedule. Not a lump sum that drains cash flow. Protect both sides from liquidity shocks. Align cash flow with actual living expenses. Step 4. Prenuptial postnuptial frameworks. Define asset classification. Growth attribute conflict arises. Track separate versus marital property. Document career pauses. Build a compensation schedule for deferred labor. Marriage isn't just love. It's a legal and financial partnership. Structure it accordingly. Step 5. Structured buyouts and transition support. If one spouse retains the primary residence, run the refinance math up front. If they can't qualify, sell. Split proceeds. Don't force an asset that becomes a cash flow trap. Use mediation to build transition budgets. Cover re-entry costs. Fund career training. Treat divorce as a business dissolution, not an emotional war. This isn't about taking sides. It's about running the full equation. Because wealth isn't divided by halves. It's divided by net economic reality. And when you align the split with actual purchasing power, the trap loses its grip. Now, let's address the elephant in the room. What if you're already in the process? What if you've already signed a 50-50 agreement and realize the math is tilted? You're not trapped. You're just operating on incomplete data. Review the settlement. Pull the tax projections. Run the liquidity analysis. Consult a forensic accountant. If the asset division ignored tax drag or opportunity cost, you may have grounds for modification. Not always, but often. Awareness is the first step out of any extraction system. The system wants you focused on the clean number. It wants you exhausted. It wants you to settle. It wants you to accept symmetry over reality. But you're not here to accept the myth. You're here to outmaneuver it. And outmaneuvering starts with running the actual numbers. So tonight, open a spreadsheet. Don't use the mediator's summary. Build your own. Column 1, asset nominal value. Column 2, tax drag adjustment. Column 3, liquidity discount. Column 4, carrying costs or refinance fees. Column 5, career opportunity cost adjustment. Add them, subtract them, find the real net value. Let the numbers collide. Not the emotions, not the guilt, the math. And if you're planning ahead, don't wait for conflict. Structure the partnership now. Track deferred labor. Document career pauses. Build a compensation schedule. Treat your marriage like the financial architecture it is. Because love doesn't pay the taxes. Math does. And when you price the invisible, the visible finally makes sense. I want to hear from you down in the comments. Are you currently navigating a division, or are you proactively structuring your partnership to avoid the nominal trap? Drop 1 or 2 below. I'll reply with a specific valuation or liquidity strategy based on your asset mix and jurisdiction. If this audit shifted your perspective, share it with someone who's still measuring fairness by a clean percentage. They need to see the architecture behind the illusion. Hit subscribe. I'm Manuel. Outsmart the system. Protect your capital. Build your buffer. I'll see you in the next deep dive.